Hi, it's Atticus Analysis, and today I want to talk about Protagonist Therapeutics. That's ticker PTGX. This one is in the news recently because the company is supposedly in talks to get acquired by Johnson & Johnson. We'll talk about that in a little bit. But obviously the price is, high because of that. It's a richly valued company, but I do think that looking at the sum of parts here, there's a lot of potential value to unlock even beyond the relatively high price that it is today. So I wanted to talk a little bit about that. Because it's a complicated story, I'm going to have to go through all the different assets. I'll try to do that in as efficient and simple way as possible. So if you look here, they have a lot in the pipeline. And there's a lot of different complicated models that have been done to try to evaluate exactly how much all this stuff is worth. And I'm going to go ahead and just try to simplify it for you. Sometimes people will have a big reveal at the end. Ta-da! Here's my big reveal. $132.88. I'm going to go through every single one of the 6 parts of the pipeline and how I arrive at these numbers. So let's go ahead and start with this first asset, Icontrokinra. That is the one that most people talk about. Now, this is a very unique situation in terms of exactly how this one is being valued, because they partnered already with Johnson & Johnson to get somewhere between 6 and 10% like ownership goes to them. The rest goes to Johnson & Johnson. And so even though this is going to be an absolutely amazing drug that's supposed to have peak sales of over $10 billion a year, Johnson & Johnson's going to get 90% of it basically. But what this does is this changes the way this revenue stream can be valued, because normally when you have a company like this that has going to develop a blockbuster drug, you have to kind of give it a conservative multiple, because if a company's never sold a drug before, they have to go out and assemble their own sales force, their own distribution network, their own advertising. It might not work out. They may have to go into debt or do dilution to assemble all these pieces. It's just not exactly clear what's going to happen when you have a company do a launch. That's why typically I will project out peak sales. I will say, okay, if a company is mature, doesn't have any growth, they've reached peak sales, I'll give it a price to sales ratio of 3. And then I'll say something like, okay, that's the max value, that's the max optimism that you're going to get is 3x peak sales. So if you want to cut that in half to provide a fair value discount, you would say 1.5x peak sales. So if a company has an asset that they're about to launch and it has a peak sales of $2 billion, max optimism would be $6 billion a year. Fair value would be something like $3 billion. That's where I'd get those numbers. And this is fairly standard stuff. I'm not coming out of left field with valuing things like that. But with this particular asset, it's very different because the company doesn't have to put any money up. Johnson & Johnson is handling everything. Johnson & Johnson is one of the largest companies on the planet in terms of drugs, so they don't have to worry about, is the rollout going to be supported with a sales force and advertising. They know how to do those things. In fact, even if the company doesn't exist, if the company gets bought out or what have you, the 10%, the 10% is going to roll in to them or whoever owns them, pretty much guaranteed. So if you think about it, in some ways it's almost kind of like a bond, because you're just sort of getting a share of Johnson & Johnson's profits, and there's no risk attached to it. There's no debt, there's no dilution, there's nothing there. So the way of valuing this is very, very, very different. I think you have to kind of assume how much profit Johnson & Johnson is going to get on the sale. You then have to factor out the 10%, and then you have to sort of say, okay, how much would you have gotten if you invested that in some sort of, relatively high yield corporate bond or something like that instead, to provide a discount in terms of the cost of time, the cost of waiting the years to collect these royalties. And that's going to result in a much higher multiple for this particular asset than you would normally have for just like a generic drug from a new company. The other thing to consider here is that because Johnson & Johnson is buying this, they're also going to look at it differently, right? They're going to spend the money on the sales force and the marketing, regardless of whether or not they end up acquiring Protagonist. But if they end up acquiring a Protagonist, it's very different. Effectively, they're just kind of boosting their own gross margin because they're taking a stream that they would have had to spend the same amount of money on, and instead of getting 90% of the profits, they're getting 100% of the profits. So it's very much in their interest, especially if they really believe in this drug. If they think that this is going to be, a $70 billion revenue stream over 10 years, and they have to give $7 billion of that to Protagonist, they could buy the whole company right now for $4.9 billion, and they'd be saving themselves a lot, and then they'd also be getting all these other assets basically for free. So yeah, I am going to go ahead and say that this is worth something like $75 all on its own, just because that's basically what you would get if you look at the 10% of the projected peak sales. Now, of course, what's interesting is you can say, what are the peak sales, right? How exactly can we project that out? It's difficult to say because pretty much every single time these guys do a private meeting with an investment firm, the investment firm changes the target and revises it up. Just a little while ago, a firm, I think it was Learlink, did a chat with them and revised their targets up from 9.4 to 13. So yeah, the more data comes out about this, the more positive people are on the launch. Even people who were really bullish on this just a few months ago didn't have a target as high as 13. So yeah, this is just a really, really valuable asset, and that's why I'm valuing it at that level. Okay, so the next asset is Rusfertide. These are all hard to say names. Now this one I am definitely going to go ahead and do a bit of a discount here. The other one I'm not giving a discount to for the fair value because, like I said, I'm valuing it differently than you would do with a normal drug launch. This is a normal drug launch, but there's also a caveat here in that they also did a profit sharing one, this time with Takeda. Takeda is saying that this should be $1 to $2 billion a year just in US sales, potentially more elsewhere, and they have two options in their contract. They can do an opt-in or an opt-out. Opt-in means that they're going to get $330 million in milestone payments. They're going to get 10 to 17% of ex-US sales, and then they're going to split the expenses and profits 50-50 for the US sales. Or they could do an opt-out, which means they give up all of the rights to Takeda for US sales, but they keep 14 to 29% worldwide sales, and they get an additional $1.375 billion in milestone payments, which is quite a lot. So if we go ahead and go back to what I'm calling this fair value here, I'm basically saying that the fair value here is $1.5 billion. I'm being very conservative here because, again, if they go opt out, which management has been dropping hints that they plan to go opt out, they're getting the $1.375 billion up front plus the 17 to 29% worldwide sales, which I'm counting that basically as very, very low. So saying, is this worth $3 billion? Cut that in half for fair value discount, $1.5 billion. Absolutely it is. Okay. So if we go on to the next asset, that's IL-17. Now this one, fortunately, they did not develop with some sort of co-owner, anything like that. They own this one completely. And in terms of the amount of peak sales here, again, estimates have been varying pretty widely, but now people are thinking it could be $5 to $7 billion in peak sales. It is basically just another version of the drug that they've already developed, but for different conditions. But it's the same basic structure, same basic peptide delivery system, and a very similar drug with a very similar drug in a very similar class was bought by Eli Lilly for $2.4 billion. We'll come back to that $2.4 billion in a minute. But that's just an example of how much this thing could be worth. This, again, it looks like it's best in class. It looks like it would be way more potent than other drugs. It's easier to deliver than other drugs. It's oral therapy. It's fantastic. We don't need to go into the details of the science. This is complicated enough, but it is a potential blockbuster. The only concern here is that this is in phase 1 trials, so you have to put a discount on that. Now, in my opinion, this probably should be valued more highly than a typical phase 1, but I don't necessarily want to be too optimistic here. I'm trying to be as conservative as possible with these numbers to show that even if you're conservative, you can still end up with a big fair value here. So I think you should go with a higher level than a typical phase 1, because this is a company that's proven that they've been successful. They have 2 drugs that have already succeeded in phase 3s, and this new drug, IL-17, has an extremely similar mechanism targeting a similar class of diseases, so it's almost certainly going to succeed. It's almost certainly going to be best in class. But the one thing to keep in mind here is that this is going to be a while before it gets to launch. It's not going to launch soon. They just started phase 1. Phase 1 hasn't succeeded yet. They're going to do a phase 2 after this, and then they're going to do a phase 3. So they're going to have to do 3 waves of trials, and then they're going to have to ask the FDA for approval. So, probably no one's going to beat them to the punch because nothing in development looks this good. But that is the one thing, is that we are going to go ahead and say, okay, that there is a time cost here. So because of that, I am going to go ahead and, instead of giving it 3 times peak sales, which is what I would do for a drug that, I would say 3 times peak sales is back optimism, and then I would cut that in half to 1.5x peak sales. That's what I would normally do for a drug that has passed phase 3 trials and is about to do commercial launch or in the very early stages of commercial launch. With this one, I'm going to do 1/10 of that to account for the fact that it's in phase 1 right now. So I'm going to do 0.3x peak sales and 0.15x peak sales for fair value, which is going to be $16. All right, the next one's going to be Hepcidin. Now, Hepcidin is basically just a better version of rusfertide, but again, it's 100% peak owned. Now, the problem here is that this actually isn't even in phase 1. This is just in preclinical. This is just a compound they developed that they would like to get into phase 1 soon. That is already even further out than IL-17. So because of that, because it's so far removed, I have to go ahead here and say that this is going to be even less. I'm only going to value it at 0.1x peak sales and 0.05x peak sales for the fair value discount. But yeah, if this drug was successful, it would probably displace rusfertide. There's a pro and a con here. The pro is that because this is just a better version of the drug they already developed, again, it's more likely to succeed. The con here is that they would be cannibalizing some of the sales that they would get from rusfertide, but then again, if they're going to go for the opt-out, it doesn't necessarily even matter that much. So yeah, that's one of the reasons why I gave that a big discount. For GLP-1 weight loss, I'm assigning that 0 value. Other people can speculate here. That's an incredibly competitive category. There's every company in the world is trying to do this, so I'm just not even going to assign it any value. In my opinion, it's actually more likely to be a negative value, just because the company could spend money developing this and then it ends up not going anywhere. So me saying 0 is, in my mind, actually probably the most generous number that I gave them in this spreadsheet, because I think it's most likely a negative asset. Probably not a hugely negative asset, but still, I just don't think that, this space is just too competitive. And then finally, you have the platform itself. So here's the question. They've developed 2 drugs that are on the verge of, launching soon commercially and being blockbusters. They have 2 other drugs in the pipeline in early stage development, which could be absolute blockbusters. And they developed all this relatively quickly. This platform, this peptide oral delivery system, which is, producing these best-in-class drugs, how much is that worth? And it's hard to kind of separate this from the value that you would attach to something like IL-17, right? It's hard to say exactly what that would be worth in an acquisition. But let's go ahead and take a step back and look at that number that I mentioned to you earlier, that Eli Lilly bought a comparable asset for $2.4 billion, right? So if Eli Lilly bought a comparable asset for $2.4 billion, one way of looking at that would be to say, okay, how much value am I assigning to both the platform and IL-17? Well, I said that IL-17 was worth $2.1 billion. Cut that in half for fair value, and you're looking at $1.05 billion. Let's just call the platform $1 billion. I'm not going to cut that in half for fair value. That would be the value that the company would be worth in an acquisition. And so you add those two numbers together and you get $2.05 billion. So I'm actually valuing IL-17 and the platform itself at less than what Eli Lilly paid for a similar type of a company a little while ago. So once again, I'm being pretty conservative. So you add all these things together, and what do you get? You get $132.88. And, you know, compared to a price of $79 today. So, yeah, there's a lot of conservatism built into this. It's possible that Johnson & Johnson will be willing to pay more because, like I said, they really value this revenue stream because of the unique situation they have with Icon Shokinra. So, yeah. And the thing that really impresses me the most here is that, again, every single time these guys talk to anybody, every single time they do a presentation, every single time they disclose more information, the peak sales of these drugs end up just getting revised up and up and up and up and up. This story was not this, was not this appreciated a year ago. There's a reason why the stock is up so much. It's not simply speculation. It's not just multiple expansion. Every single time the stock has been going up, it's because people keep understanding more and more about how good the data is. They keep putting out more and more pieces of information about all of the additional data points that they have, and people keep saying, okay, we think it's going to sell more. We think it's going to sell more. So on a sort of price to peak sales basis, I don't think the company has become that much more expensive at all. The only thing that's happened is the company has gotten closer to commercial launch, and you and I can be more confident that the management team knows what they're doing. But on a multiple basis, I think the company is probably just as expensive as it was a year ago. If a year ago you understood the science at such a level that you knew all this was going to happen, well, congratulations. But yeah, aside from that, I actually don't think that the stock has become more expensive as we found out more information. It's in the same way that a stock like Nvidia hasn't really become more expensive. It's just kind of been going up in the way earnings have been going up. Now, a lot of people are going to say that stock's in a bubble. We're getting off track, but yeah. In any event, I hope you enjoyed this video, and let me know your thoughts.